For any problems they face, governments around the world are now conditioned to deficit spend or issue fresh trillions in new currency. So how in danger are we of that recklessness leading to a breakdown of the entire system? Respected analyst Michael Every suspects that we're closer than most realize.
I agree. I think systemic breakdown is a significant risk, and we're seeing more and more signs of it. I mean, for example, if you consider the fact that negative interest rates are quite normal in many countries now, they've been institutionalized. What's that? Nothing but a kind of permanent default locked into the system. We just accept that as normal. Yield curve control, actively being embraced by some central banks. Rumors that the Fed is going to go there at some point eventually, and logically they may well do. What's that? That's the end of capitalism to a degree, in that you don't have a free market for capital. So if this isn't indicative of a systemic break, I don't know what is.
Welcome. I'm Adam Taggart, founder of Wealthion, where we bring you the wisdom and perspective of the world's top experts on investing, economics, and personal finance. This video is another great discussion in our ongoing series called Insights from the Masters of Wealth. I sat down recently with Rabobank's Michael Every to discuss the truly great structural challenges that the global economy faces. They are so big, in fact, that Michael worries about a potential end to capitalism as we know it. But before we get started, please just take a quick second and subscribe to this channel below. This Wealthion channel is so new that each subscriber we get helps ensure that we're going to be able to continue bringing you these excellent guest experts going forward. All right, with that out of the way, let's get straight to the interview with Rabobank's Michael Every. And this week we have a very special guest. We welcome one of the hardest working macro analysts in the business today, Michael Every, head of financial markets and research at Rabobank. The rapid frequency with which he publishes his highly insightful market commentary is staggeringly impressive. Michael, thank you so much for joining us today, all the way from Singapore, no less.
Thank you very much. It's a pleasure to be with you.
Thank you. Well, look, I always like to start these interviews off with just giving the guests the opportunity, without any presupposed biases or coloring by me, to answer this question. What is your assessment of the current state of the global economy and financial markets?
That's a great place to start, because you can go to so many different locations. I'm deeply concerned. And in fact, the title of the note that I just put out before we started this chat now was Baked Alaska. And that's a reference to both what's expected to happen in Alaska on Thursday this week, where we have the US and China having a chat, which of course is very important for the outlook for the global economy and markets. But also for those who aren't familiar with the dessert, and I'm presuming maybe many Americans aren't, it's more of an Anglo dish. It's basically a hot dessert with an ice cream core. So it's red hot, piping hot on the outside, and it's freezing cold in the center. And I think that's a good place to start as a discussion point.
Okay. Well, why don't you continue to build on that? So as you look out here, what is the hot exterior and the cold interior?
Well, it really depends on how you analyze these things. I mean, you have bulls and bears in markets. Obviously, you have people who take a long and a short view in all different kinds of assets. I find that one of the biggest differentiators in terms of how you see the economy is what lenses you are wearing when you look at it. For example, do you believe economics as a discipline? Do you think a macroeconomics textbook actually describes the real world as we see it around us? Do you take a broader view? Now, I'm openly, and have always been, both an amateur economic historian and a more heterodox economist. So I'm firmly from the post-Keynesian or the Minsky school. And we can maybe spend some time talking about that if you want. But in a nutshell, Sure. It basically means I don't believe most of what I read in contemporary economics textbooks. And I don't believe it because for years I've been saying things over my professional track record, many things wrong, of course, as everyone gets wrong, but saying things like, for example, in the mid-2000s, there's an epic American housing bubble, which will end up with a 1930s style crash, which will take most of the world down with it. Well, that was not well received by people who were reading only macro 101 economic textbooks saying we've never been better off, and this just can't go wrong, including the Fed, by the way. And if you take that view, which is effectively a political economy view of the world, everything is political. Every construct around us is political rather than natural. You can recognize where it does and doesn't work, where it would or wouldn't have to change. And the simple fundamental that I want to speak to, which gets lots of play now, but I've been arguing for a very long time, is that fundamentally, on a global basis, but in the US very much so, labor has very little power in terms of the organized power of the working class. And capital, meaning international markets and big business, has all the power. And that disparity effectively keeps the global economy ice cold at its core. But of course, we fight that with ultra low interest rates and mega central bank liquidity, thinking that a cyclical reaction to what is a structural political problem will solve that problem, and it won't. But all that extra sugar makes parts of the economy red hot, but generally for people who are doing well anyway. So the better off get richer and richer, and the poorer get left more and more behind. And that's my baked Alaska thesis.
All right, baked Alaska, you're sort of making me think of the famous Einstein quote of insanity, right? Doing the same thing over and over again, but expecting a different result. You know, the answer seems to be, well, let's just put more liquidity into the system. And, you know, at the end of the day, all that does is make the wealth gap that they say they're trying to address even worse.
You're absolutely right. I don't think that Einstein quote is actually apt for one reason, and that is when you talk to a lot of the people involved in this process, the functionaries, like your mid-level economists, and commentators, I think they do fall into that particular category. They do think, well, this time we'll get it right, this time we'll get it right, this time we'll get it right. But if you look higher up, I refuse to believe people as intelligent and as well educated as some of the ones who are making these decisions aren't aware of what they're doing. I think it actually suits them to say, well, let's give myself another $1 trillion. Oh, that didn't work. Let's give myself another $1 trillion. Oh, still didn't work. Shucks. You know what? Let's give myself another $1 trillion. It's going to work next time, folks. They know what they're doing. Of course they know what they're doing. You would have to be an absolute moron not to see how this actually works.
All right, so I didn't want to get here this early in the conversation, but I'm going to go here anyways. Is that evil? Is it
evil?
Yes. Is it evil? Is it, you know, if they're smart enough and they know that it's not having the public intended effect, but it's having a very beneficial one to them personally, is that evil?
Well, let me try and sidestep that for a moment before coming back to it. Adam Smith, who of course we're all aware of, he was not a free market advocate in the way that he is portrayed in America today. He was, if you read the biography of the man, a moral philosopher. So morality ran through everything that he was doing, like letters through a stick of rock, you know, when you go to the seaside. That's what he absolutely cared about. And the great economic philosophers have all been deeply moral. I don't like to use words like good and evil because I think they become far too subjective and judgmental, and it's all in the eye of the beholder. But it's very much dysfunctional, and that's what worries me. Because in the long run, if a socio-economic system or a political economy is dysfunctional, it will end up with very, very bad things happening. And in early 2019, I published a report called The Age of Rage, which was about 15,000 words long. I think it was a bit of an epic, and basically said, look, I've been tracking these things for nearly 2 decades. If you look at the socio-economic indicators and the political warning signals that I'm getting, we are about to enter a period of social and political breakdown, even in the US and in the West, where you're going to have the risk of, you know, I didn't use the word riots, but I kind of implied it. And I said a shift to the left and to the right. So you have the alt-right, which is, of course, now common parlance. And I said you will have the control left. And when you get control and alt, you get delete. And that is unfortunately what we're starting to move towards, control alt delete, where the system starts to break down because the center cannot hold. And we see more and more signs of that, not just in the US, but all over. And we've seen that before in history, but things can and do crumble away if they are dysfunctional enough.
All right, so I want to keep tugging on this thread in multiple ways, but just to pick up on that last point. Let's talk about the why and the when, right? So history is replete of regimes that ended up collapsing unto themselves, political regimes, economic regimes, et cetera. I think there's a lot of people, certainly that we've been talking to in this program, sounds like you're one of them, that thinks that we really are staring at the risk of a real systemic breakdown at some point if the status quo continues. What do you see as the most likely triggers for that? And is this a near-term problem or a problem that our children are going to be dealing with?
That's another great question. I agree. I think systemic breakdown is a significant risk, and we're seeing more and more signs of it. I mean, for example, if you consider the fact that negative interest rates are quite normal in many countries now, they've been institutionalized. What's that? Nothing but a kind of permanent default locked into the system. We just accept that as normal. Yield curve control, actively being embraced by some central banks. Rumors that the Fed is going to go there at some point eventually, and logically they may well do. What's that? That's the end of capitalism to a degree, in that you don't have a free market for capital. So if this isn't indicative of a systemic break, I don't know what is. Is it a problem for our kids? I think it's a nearer term problem. I mean, we're talking about potentially yield curve control happening in major economies within the next 6, 12, 18 months, depending on how the data pan out. Does that mean everything that as we understand it, breaks down and collapses around us? Well, no, because even after the Roman Empire collapsed, if we want to go that far back, day-to-day life for many people carried on in a similar kind of fashion, even if the quote-unquote barbarians were sitting there in Rome. They inherited a lot of Roman law. And if you look even at Europe today, ironically, just within the last few days, the French government has been lobbying to reintroduce Latin as the common language within Europe now that the Brits have left. So you see things continue and they fall apart at the same time. So it wouldn't be that suddenly we're all sitting there going, well, goodness me, how did we get here? But like the frog in boiling water, which is often referred to in an environmental context, the same thing would be happening systemically in terms of how we understand our political economy and what we can and can't do within it, and what that does and doesn't mean for quote unquote free markets.
Okay, so I have this sort of dual issue I'm looking at, which is that within the economy as a closed system, I see us doing things that are highly unsustainable. And we talked earlier about the way in which the system is currently being run. More and more of the capital is ending up in fewer and fewer pockets, right? So you're having this massive disparity between the very top and everybody else. And at the same time, the cost of living is rising. I'm much more U.S. focused than you are, because you cover a lot of global markets. But I sense this is true in a lot of other countries. So of the dispossessed majority, they're just getting increasingly squeezed. And that seems like there's a breaking point at some point, right, where social unrest comes out. In parallel with that, you have this, you talked about how you look at the economy, and they're kind of classical economists look at it a closed system, right? Okay, well, if price goes high enough, supply will come online, right? But we live in a finite world, and we are beginning to hit, some planetary limits on some key resources. And that's being funded by more and more debt, right? So at some point, we're going to have less resources per capita to go around than many parts of the world has been used to. And all that debt that's been built up, has this expectation that there will be more energy there to create whatever that debt was borrowed to finance. And we may get to a point where there's just going to be constraints where that mountain of debt is faced with having to default, because there's literally just not enough either energy to power the economy, or of the key resources to build what needs to be built. There are going to be shortages there. So I see these sort of dual massive unsustainable systems that are going to have to come into play at some point. I guess my question is you don't have to share that view or not, but if we're staring at big unsustainable issues like that, kind of how do you see this playing out? And of course, the classic question is it inflation? Is it deflation? Is it by default or currency destruction? I guess let me leave it there and let you respond.
Well, okay, let me try and summarize how I see these things, because one can decompartmentalize different parts of it. And I think that's a valid thing to do, but you need to look at the totality as well. And if we think of this globally, you are completely correct. The only closed system is the globe. It's not any one economy. So we have to look at it globally. And effectively, the long run bullet point that I've argued is when you're projecting this forward, and I think your analysis is correct on all fronts, you only really have two logical endpoints that you move towards. I mean, this is how I do all of my analysis. I start, where can this go as an inexorable logical process, and how many different end games are there? And then I follow as we're tracking along towards one or the other. And they're really simple. We either have Star Trek or Star Wars. And maybe younger viewers may not be familiar with what those two paradigms mean, given that both of them are pretty rubbish nowadays compared to how they used to be. But I mean, Star Trek, used to be optimistic and shiny and futuristic, and saying that we had one world or one universe all living together with, I think in Star Trek, they didn't even have money anymore. And you used to press a button on a machine and got food out of it that was created just from atoms. And effectively, there were no environmental constraints. It was more just about the moral challenges and the human challenge of just constant exploration. But we'd overcome all those constraints because we had unity. Star Wars, again, before it got dragged into the culture wars, which it has in the US in particular, was just about good versus evil and, the empire versus freedom fighters. And in a nutshell, that's effectively what you're going to see. You're either going to have a unified world where everyone realizes we're in this together. We have to adopt these key technologies together or work together to overcome the physical limits of what this planet is imposing on us, which would allow some kind of system to be maintained. But to do that means you have to square the gap between the winners and the losers inside each economy. Good luck with that. And the winners and the losers between each economy. Good luck with that. Good luck with that. Because that's an integrated process. Obviously, there's a Venn diagram that you could easily draw, right? You've got to do that, and you've got to do it fast. Or you end up with basically the goodies versus the baddies, and everybody will think they're the goodies. And logically, that's the only two endpoints I can see. And what do we have at the moment? Globally, a lot of talking about building back better, which is pure Star Trek. But unfortunately, it's about a science fiction of Star Trek. I've yet to see a single plan that deals with that logically. Or we move inexorably towards a more Star Wars environment. And well, again, we've got the US and China talking in Alaska this week, and it looks a lot more Star Wars to me.
Yeah, I sadly agree with you. I love your analogies, by the way. In my mind, I'm picturing Darth Vader eating a baked Alaska.
You have difficulty getting it through the grill.
Yeah, exactly. It's hard. Yeah, it's kind of melt it a bit first. But look, just trying to be a realist here, right? I mean, each individual country, that I follow at least, they have a host of internal problems about dealing with equity and how to distribute resources and manage their own people in a way where they're just not digging a deeper hole for themselves, which it really does seem like almost every country is these days. And so, when you get stressed, people look after their own interests more. And since we can't even get our own house in order, I really don't see us getting our global community in order, unless these systems break so badly that when the dust settles, people just poke their heads up and say, look, there's got to be a better way to do this. But I sadly don't see that happening before some sort of breakdown like that. So, okay, that's at the very high level. Let's try to get a little specific in a little bit of the nearer term. You wrote a piece relatively recently that said, we soar in 2021, but we crash back in 2022. Can you just elaborate on that prediction?
Well, obviously, it depends on a lot of developments in the US in particular remaining the way they are at the moment, because things can change. But if we presume that there's no further fiscal stimulus, there's no Green New Deal, there's no infrastructure package, let's just presume that for now. What you have is a sugar high on top of this baked Alaska. So you've got icing sugar on top of baked Alaska. I mean, it's a diabetes nightmare, which gives everybody a couple of $1,000s to spend right now. And if you're already well off, And lots of people in the US are well off. You know, if you're working for a large corporation and you're comfortably working from home and you've moved to the suburbs and all's good for you, great. You get a couple of $1,000. What are you going to do with it? Just save it. You know, there's nothing much to do with it, right? That doesn't boost the economy. And if you're very, very poor, what were you going to do with it? You were going to pay the rent, or you're going to spend it on food because you didn't have much choice anyway. Those are two things you can't not spend the money on. You were always going to borrow that money one way or another, or you were going to be on the street and just disappear from GDP completely. So in neither case do you actually get much sustainable continued changes in consumption patterns. And in fact, you get like a couple of months of activity at most. That's it. And then by 2022, potentially this is all worn off. Politically, you could see, depending on how the constellations align within the US, everyone saying, we tried stimulus, it doesn't work. See, fiscal stimulus is a waste of time, which there's always a strong voice arguing for in the US. And then everyone will say, well, what can we do now? Nothing. You know, basically, let's go a more Austrian route. You know, ultra low interest rates, obviously not Austrian, but apart from that, just you're on your own. That's going to be quite the crash in 2022 if you haven't got any more stimulus kicking in afterwards.
Yeah, I suppose so. I will tell you, being in the US, I think that the more likely scenario is going to be, oh, we still have problems, we just didn't do enough. Let's give more. I mean, it really seems that American society is turning into a too big to fail society where everything is too big to fail. Oh, you know, the pensions are going under. Well, let's give them more money, right? Okay. Oh, people are burdened with student debt. Well, we just got to, you know, you got to give them relief on that. It just seems to be the answer to everything right now is to print more money. And the new administration, I think, is embracing that even more than the previous one. So, you know, we'll see what happens, obviously. But I think right now, the American mindset is just, if stimulus isn't doing the job, then we just need more. There aren't that many voices, at least that there used to be, that are you know, willing to argue restraint. And to be honest, you know, the Fed is right there along with them. You know, it's obviously encouraging fiscal stimulus because it's saying monetary stimulus isn't enough. But you know, Powell to date has been very happy to say, I'm going to do whatever it takes to keep this stuff going on. So, anyways. Let's get real specific here. So a lot of people watching this are wrestling with a key dilemma. They're observing a lot of the phenomena that we're talking about. And I should ask you this, but a lot of the commentators that we've talked to recently, you know, they're quite concerned about inflation, right? And that we're, you know, all the steps that are taking are finally beginning to bring inflation back to life. And you know, are saying, look, if you're an investor, you really should start thinking about, you know, how to invest for inflation. But the markets are on this massive sugar high that you talked about earlier. And by almost any valuation metric, they are the most overvalued than they've ever been. And people are worried that I might position for inflation, but then I might get caught in the interim by, you know, a potentially very large, maybe 50% plus style market crash, which could kind of, you know, kneecap me beforehand. So to investors wrestling with that dilemma, you know, what advice or what consideration do you have to offer?
Well, again, it depends on your risk profile. Let's get really, really granular now, because I've done all the big picture stuff, and I'm happy to go back up there into space if needs be, but let's come down to earth. It's very, very hard to generate high levels of return during this particular environment, unless you're absolutely right in terms of how the politics plays out. So that's a fact. But if you're looking to think, okay, how do I preserve capital through this at the very, very least? How do I get some income? And I know that I'm not going to get wiped out. You've got to be looking at things like treasury linkers. And I've been arguing that for years too, because if you're going to get an inflation protected treasury product, effectively, no matter how high inflation goes, you're protected on the upside. But on the downside, let's imagine that we get this surge followed by deflation, which, by the way, is exactly what we saw in the 1920s. Sorry, I can't resist doing a quick historical comparison.
No
That's
worries.
what we saw, inflation followed by deflation. Let's say we get that. Well, if you buy a linker, you're going to get it back at par. So you're going to get par back. You're not going to get anything worse than that. So you're guaranteed to at least get your money back. Whereas, of course, with an equity or something else, you can go far lower than that. So your downside is protected, and equally in inflation, you're protected too. Now, I'm just giving this as a specific thought. You can't really build up a retirement portfolio purely being in the inflation-linked treasuries. That's not a sustainable retirement portfolio. But it's just one thought to put out there that this is probably the only product that guarantees you both-way protection in this environment.
All right, and you're calling them inflation-linked treasury securities. Is that what goes by the name of TIPS? Otherwise, goes by the name of TIPS.
Yeah. Excuse me. I lean more towards the British terminology, being a Brit. But yeah, TIPS is what they're called in the US. Yeah.
Okay. Great. Right. So okay, that's a great suggestion for folks to consider. And it's been so hard because with two things. Treasuries have and pretty much still yield very little, right? When you talk about inflation, the tips are linked, I believe, to the CPI, which a lot of people feel is actually very underrepresentative of what true inflation is out there. But I guess
Sure.
Getting something back is better than nothing, right? So I'm going to talk to the lead partners at New Harbor Financial, as I do every week after we finish up here. And they have a pretty high cash/treasury position right now because they're so suspicious of current market valuations. And I guess my question for you is are you one of those people like them that just says, given the lay of the land right now, it probably pays to be defensively positioned? Because I think, as you said earlier, it's the risk reward profile really seems pretty imbalanced at this point in time if you're trying to reach for future returns at these lofty heights.
Okay, well, I can only talk personally here. I want to make that abundantly
clear.
You're
You're not giving personal financial advice. You're just giving a broad.
This is not advice. On a personal basis, anyone who knows me knows that I've been arguing only two things for my own portfolio for years, which is long cash and long US treasuries and duration and the US dollar. And the dollar's come off a bit recently, which has not been so good. But the long US treasury trade was a fantastic one through all the intermittent periods where you had the far more famous people than myself saying US yields are going to 3% and 4%. So no, they're going near to zero. And down and down we've gone. Ironically, though, as someone who has embraced that for years and missed out on all the equity upside, on a personal basis, I'm becoming more and more convinced that if you can't beat them, join them. Because for a long period of time, I kept thinking, okay, the systemic breakdown is going to mean another 1929. We're going to have another GFC, another one of these crashes. At which point, I won't be able to sleep at night thinking I've personally lost X% of all my hard-earned savings. What we're actually seeing in terms of the behavior already exhibited that we referred to at the beginning of this chat is that no, the system now is basically telling you there is nothing to do but act as moronically as the biggest moron next to you, and that acting prudently is going to see you punished. Now, again, this is not investment advice. It's a very, very sad head in hands recognition that the system is being set up for basically idiocracy. Do you really think, we can get crashes, don't get me wrong. I can see a world in which equities correct quite severely. But were that to happen, does anyone believe for a second that any White House and any Fed that we currently have would not turn around and say, we will do whatever it takes to push them back up again instantaneously? Whatever liquidity channel has to be created will be created. Whatever jawboning has to be done will be done. Whatever package has to be passed will be passed. Because when you have a Senate and Congress, which, or the Senate in particular, which is not exactly full of poor people, you're not going to get much political backing to say, well, let markets do what they will.
All right. Well, I do find that very sad, but I do completely understand the perspective. And I guess my question is I mentioned earlier that we've sort of become this too big to fail society where everything, stock market included, right? Oh, you're taking losses? Don't worry, right? We're stepping in to fix it for you, right? So I guess my question is if you really think that that's the way the world is headed, the markets are headed, et cetera, then you really have to ask yourself, all right, what's going to happen to the currency, right? We're just basically using it as this universal answer to just everything else is just more money. We'll just make more money. So obviously you get into trouble with the purchasing power of the currency the longer that goes on. Do you have any advice for people who have that concern of, look, I want to protect myself just against the devaluation?
Number one, you need to think, what assets do rich people want? Because effectively they're the ones setting the rules. It's not what do you want. It's like, if rich people are going to say this is what keeps value, it's probably going to keep its value. And secondly, from a global perspective, in terms of your portfolio, which countries do you think are going to emerge well from a bare knuckle fight, looking at all the resources you need to win one in a world in which the world's rich are against the world's rich? Because, you know, not every rich person is going to be able to have the window seat during this particular episode. So from a currency perspective, I'm still more in favor of the US dollar, which might surprise people, because I see what's happening in the US. But if you think that isn't happening in Europe, if you think that isn't happening in the UK, if you think that isn't happening in Asia, if you think that isn't happening in China, frankly, you're not reading enough newspapers from other parts of the world, and they don't have the army or the natural resources to match what the US does. So I still prefer the dollar overall in the long run, even though I accept the dollar's on the back foot at the moment, and the Fed is doing everything it can to push it down. So cyclically, I see that. Structurally, it's like pushing a balloon underwater. It's going to keep popping up until the whole global power structure shifts. And I think that you have to at least keep part of your portfolio, if not all of it, in what do the rich want. So I'm putting forward a suggestion of a balance, purely hypothetically. And I'm talking to myself. My wife's listening in the background, and she'll probably be saying, right, Mike, when are we going to go and do this? Some of it in tips, and some of it in ultra luxury products that the rich like, and then you've got both bases covered.
Great. So you basically got your caviar production and your tips, right?
Exactly, and that's what you call a diversified portfolio in a collapsing paradigmatic world.
Okay. Well, Michael, thank you so much. For time-wise, I'm going to have to leave it there, and you've got to go actually really, start your day there in Singapore. But thank you so much for taking so much time with us. Great to have you on. I hope we can have you on again at some point later on this year to kind of, give us an audible read on what the landscape's like then. As we close here, for people who have really enjoyed your commentary and would like to learn more about you and your work, where should they go?
Well, if you go to the markets research division of Rabobank, you can find some of my stuff there. And equally, some of my commentary is found on various financial market news aggregators. So if you Google Michael Every and Rabobank, you'll usually find a few comments from myself there. But more specific, detailed commentary, I'm afraid, is for clients only. I'm sure you can understand.
Oh, absolutely. I know I see your work quite often on zerohedge.com, and I'm sure a lot of viewers are readers of Zero Hedge. But yeah, if you want to follow Michael's work, that's a pretty easy place to follow it. I mean, literally, Michael, you have a post there almost every day. So it's, and you're writing stuff for clients on top of that. I honestly don't know how you do it. But anyways, thanks so much for joining us. And like I said, love to have you back on the program at some point.
It'll be my pleasure.
All right. Thanks so much, Michael.